So let's talk about something we use pretty much every single day, but maybe don't think about all that much: the modern banking system. We're going to break down how your money goes from being locked up in a physical vault to living in the virtual world, giving you all this financial power right in the palm of your hand. Let's dive in.
I mean, it's a pretty basic question, right? But the answer is actually fascinating. You deposit your paycheck, you pay your bills. But what is happening behind the scenes? Where does that money really go? That's the mystery we're going to solve today.
Okay, first things first. We have to understand what a bank truly is at its core. The best way to think about it, it's like the headquarters for your money, the central command center for all your financial activity. At its heart, a bank is basically a financial matchmaker. It takes in money from people and businesses who have extra savings, and then it lends that money out to other people who need it, to buy a house or start a company. But here's the really crucial part. They don't just let your money sit there. They only keep a small bit of it on hand. The rest, it gets loaned out. That simple process is the engine that keeps our economy moving. But of course, today's banks are way more than just a place to store and lend money. They've really become a one-stop shop for our entire financial lives. They handle everything from simple stuff like transferring funds or paying your electric bill to more complicated things like exchanging currency or providing financial guarantees for big business deals. So now we know what a bank does. Let's get a little more practical. If the bank is your money's headquarters, then your account is its actual home. And believe me, picking the right one makes a big difference. So you've generally got three main choices. First is the current account. Think of this as your daily workhorse. It's built for lots of transactions with no limits on withdrawals, but you probably won't earn any interest. Then there's the saving account, which is for, well, exactly what it sounds like. You'll earn a little bit of interest, but there might be some rules about how often you can take money out. And finally, you have the fixed deposit. This one's a commitment. You agree to lock your money away for a specific amount of time, and in return, the bank gives you a much higher interest rate. Which one is best for you? It really just depends on what your goals are. Before we had apps and cards and could just tap to pay for things, this little piece of paper was the main way to move money around without carrying a bunch of cash. Let's take a quick look at the classic check. The most important word on this slide is unconditional. Seriously, a check isn't just a request or suggestion. It is a direct, formal, legally binding order from you to your bank. You are literally instructing them in writing to pay up. The whole process has three main players. There's you, the account holder. You're the drawer because you drop the check. Then there's your bank, the drawee, who gets the order to pay. And finally, there's the payee, the person or company who actually gets the money. Pretty simple when you break it down, right? But what happens when that order can't be followed? Well, that's when a check gets dishonored, or as most of us call it, it bounces. It just means that for one reason or another, the bank has refused to make the payment. And a lot of the time, it's because of simple human error. A check can bounce because the signature doesn't look right, or because the amount written in words doesn't match the numbers, or maybe there's a scribble on it, or you forgot to write the date. Of course, it can also be on purpose, like if you call the bank and tell them to stop payment. These might seem like tiny details, but they matter. A lot. This brings us to a really vital idea: keeping track of all this money. See, you've got your own records, and the bank has theirs. And sometimes they don't quite line up right away. This really shows the two sides of the story. You have your personal record, your ledger, where you track every single thing you do with your money. But the bank's record, your official statement, only shows what's actually gone through the account. Now here's the interesting twist. They're mirror images of each other. For you, a debit might be money coming in. But for the bank, a debit is money going out of your account. That difference in perspective is exactly why it's so important to actually read your bank statements and make sure they match what you think happened. All right, that's enough about paper. Let's fast forward and jump straight into the digital age. This is where the bank stopped being a building you had to go to and turned into something you could carry around in your hand. The first big leap was something called the Any Branch Banking System. And honestly, this was a game changer. Before this, you were pretty much stuck dealing with the one specific branch where you opened your account. ABBS connected all the branches together into one network. All of a sudden, you could walk into any branch of your bank anywhere in the country and manage your account. It was the first real step in making banking portable. And then, of course, the internet showed up. And with it came e-banking. This changed absolutely everything. Suddenly, you didn't have to go to a branch at all for most things.
You could check your balance, transfer funds, pay bills, all from your home computer anytime you wanted. This was the real birth of virtual 24/7 banking.
And that brings us right up to today. Mobile banking basically took all the convenience of online banking and squished it down into an app that lives in your pocket. It's not just about seeing your balance anymore. It's about having a secure, full-service bank right on your phone, letting you run your entire financial life while you're on the go. The convenience is just incredible.
And of course, we can't talk about modern banking without talking about plastic cards. It's really important to know the difference. An ATM card is the simplest. It's just for getting your own cash out of a machine. A debit card lets you spend your own money by taking it directly from your account. But a credit card? That's totally different. When you use a credit card, you are borrowing the bank's money. It's a short-term loan that you have to pay back.
So, there you have it. We've gone from paper checks to tapping our phones, from having to visit one specific building to being able to do our banking from literally anywhere in the world. It has been a wild transformation. And it all leads to one big final question. As our money becomes faster, more invisible, more virtual, what's the next big thing? What does the future of banking even look like?